In this video, we're going to continue talking more about some financial statement issues and measurements, metrics, if you will, and how we can maybe use that to understand what goes on inside the company. In addition, we're also going to talk about taxes. So there are some performance measures. Your book says here basically that accounting statements are insufficient because they do not reflect market values. I take a little bit of issue with that, right? I mean, all of our measures of performance come from accounting statements. Obviously, none of them have market values with them. There are measures that, as we'll discuss here, there's two that we can use that are a little bit different, and they utilize, at least one of them utilizes the stock price itself. Now, there are challenges with using market values, right? Because market values change all the time. If the stock market is declining, right? If we're having a recession and stock prices are declining, does that mean that those companies are doing something wrong, or that managers are making bad decisions? And the answer is no, because the price of stocks is driven by demand of investors. So there are issues with all metrics, right? Every metric has both its strengths, the things that it's developed for, but it also has some weaknesses or assumptions that we need to understand. So in this case, we have two measures that are becoming very popular actually with companies. One's called MVA, market value, right? Market value added. And this is just the difference between the market value of the stock and the book value. Now, we know what book value is, right? It's total assets minus total liabilities, or it's equity for the company. So this is just the market value of the equity minus the accounting value of the equity. And of course, if management is doing what they're supposed to do, and they're increasing the wealth of shareholders, market MVA should be positive and should hopefully be increasing. Now, EVA is economic value added, and this is an estimate of a business's true economic profit for a given year. And as you see here, it's EBIT times 1 minus T. So this is also sometimes referred to as NOPAT, net operating profit after taxes. Subtract from that a calculation, right? And this is the calculation of the total invested capital, right? These are the operating assets, total, times the cost of capital. Now, this gives us what they refer to here as the true economic profit for a given year. This EVA can actually be used in divisions, right? It can be broken down and have a division number. So some companies are starting to use this for some of their performance markers. So if we look at Coca-Cola here, we can see that in general, the MVA has been growing. So our assessment of that would be obviously that managers have been doing the right thing by investors, and they've been able to increase their wealth year after year. We also see that with the exception of the very first year, EVA has been positive every single year. So again, this is also telling us that they are adding true, sorry for the spelling here, true economic value to the company. Now, again, MVA cannot be broken down by division, but EVA can be broken down by division. If EVA is positive, then the after-tax operating income must be greater than the cost of financing, because that's the only way EVA can be positive. We're showing operating income and we're showing the cost of financing the business, and it's greater. So on an annual basis, right, EVA, if it's positive, it helps to ensure that managers are doing, or it shows us that managers are doing the right thing, and that MVA would be positive. So MVA is applicable, as we mentioned, to the entire firm. However, EVA can actually be used on a divisional basis. So we can, for instance, maybe, let's say mid-level management, they get bonuses. We should tie our bonus calculation to EVA, not to earnings per share. Earnings per share, we talked about, accounting's got some issues with it because of its methodology, but EVA eliminates that methodology, so that gives us a more true picture of increasing value for the firm. So now let's switch and talk a little bit about the taxation system. And of course, you know that there are individuals and corporations. We're not going to spend a lot of time talking about individual taxation because this is a corporate course, but we will spend some time talking about some of the differences between the two systems. Both systems have what historically have been a progressive structure. That is, the higher the income, the higher the marginal tax rate. Now that has recently changed. In 2018, there was this big change that came about. So now corporations are subject to a flat tax rate of around 21%. Also, state taxes, when you add that, it's around 5%. So if you want to think about what do corporations pay in taxes, on average, it's around 26%. In addition, there are some limits to how much deduction companies can take for interest. So between 2018 and 2021, there was a limit, and there was a calculation based on what's referred to as EBITDA. That's earnings before interest and taxes, depreciation and amortization. And after that, it's 30% of EBIT. So it doesn't matter how much money you borrow, you cannot deduct more than 30% of your operating profit. This may put a chill on borrowing. The companies may recognize that, if you can't take all of the deduction, why would you use that piece of financing? As we'll see later when we talk about things like the cost of capital, this will have influence on the costs of doing business from a financial perspective. So it's in some ways it's made it a little easier to understand the taxes of corporations. On the other hand, it's also added a little twist to decision making now. So individuals, typically you pay started around 10%, that rises to around 37%. However, there is a large segment of our economy, very low income earners, that pays zero tax to the federal government. So again, it's 37%, but that typically is only for people that make some substantial income, $500,000 to $600,000 a year. And obviously there's always some state taxes if your state has taxes. And we've seen that there's been many states that do not pay taxes, and they've actually seen some flow of citizens because they're tired of paying the higher taxes for some of the high state tax rate states. In addition, we have a standard deduction. Essentially what this means is the government allows you to write off a certain amount of tax free. Sort of what I talked about a second ago. So if you're married filing jointly, the first $24,000 that you earn has zero tax. So if you and your spouse only make $23,000, you would pay no federal taxes. Now, there are some other things that they used to have, which we refer to as personal exemptions. Those have all disappeared. And this isn't a personal tax course, so we don't want to get into too much detail. Interest and dividends are very important to understand the differences and how they're treated. Again, interest that's paid by the corporation is deductible to certain limits right now. For individuals, interest is tax deductible, but only if it's attached to equity. So both individuals and corporations can take an interest expense, if you will, but there are limits on both sides to how that can be done. Interest earned is fully taxable. The only exception to that is interest from a municipal bond. Dividends paid out to investors, the dividends paid out, that is not an expense of the corporation. That on the income statement is shown after taxes. Of course, when individuals receive dividends, they pay taxes. Most investors pay around 15%. So again, depending on your income, that will determine what rate you pay. It can either be 10%, 15%. I don't want to get into what qualified dividends are right now. You pay 0% on qualified dividends. Again, they're typically paid out of net income, which means they've already been taxed. This is, we mentioned this in some earlier videos. This is what we refer to as double taxation. A corporation, though, that receives dividends from another corporation can exclude some of those dividends to avoid triple taxation. Some other basic tax issues but if there is a tax loss by a corporation, they can carry that loss forward. So if we lose, let's say we have taxes this year that are negative, right? We can move that. If we make money next year, we can offset next year's income with some tax losses this year. Capital gains, that's the sale of our plant and equipment, or maybe a division, right? But it's a sale of our operating assets. There's tax obviously paid on that. Most individuals and the corporation pay around 15 to 20% on those long-term capital gains. And of course, single taxpayers, right? If you make over a certain amount of money, that could actually get to that top range of actually 20%. So capital gains is in the news a lot, right? We have our legislation, is really against capital gains having reduced taxation. And I kind of understand the process and the meaning of that, right? Or why they're upset with that. But this is the way capitalism works, right? When you invest in investments like stocks and bonds, when you sell those, that's a capital gain. You pay a lower tax rate on that than you do on regular income. And there's issues with that, I guess you could say. I do want to spend just a little bit of time, and I know that we don't talk about this a lot, and it's not terribly important for us to understand exactly what's going on here. But I think it's important for you to understand how taxes are calculated when we do not have flat taxes. Why is that important? Because someday legislation's going to change and they're going to get away from the flat tax. So let's see how taxation works. How do you calculate this? Well, there is what we refer, this is for a single person, right? And this is the 2018 tax code. So it's obviously old, but how you calculate it is still the same, right? So if we make $90,000 and we're a sole proprietor, we have no other income, we need to figure out what is the tax. How do you figure that out? Well, you find the number, the income, it's on this line. So our tax that we will pay is this formula right here. So 90,000. So we're going to pay $14,090 plus 24.24 times, now this is what, 90,000 minus 82.5. So that to me looks like $7,500. So that is going to be the tax that we pay. So real quick, I'm going to cheat and look at my here. That is $15,890. Now, from a decision-making perspective, the tax we're interested in is this tax right here, 24%. If I made $90,001, what would be the tax on that next $1? 24% is that answer. Now, what happens as you make more and more money, this marginal tax rate becomes very, very close to what we refer to as the average tax rate. Now, let's look at that for a corporation. What if you made $90,000 from the corporation? Again, no tax, no other income, etc. What are the tax rate? So again, find 90,000. It's on this line. That's 13,750 plus, again, now it's 34% times. Now this is the difference between 90,000 and 75,000, which is 34% of 15,000. When we calculate that, again, I'm trying to cheat and look at my answer down here in the notes. You can see that is $18,850. Now, for the corporation, what happens? What is the tax if they make more money? If they make one more dollar, how will that be taxed? That will be taxed at what? 34%, right? For the individual, it was much less. Now, again, remember that right now the corporate tax code is flat. It's 21% for all corporations. Don't forget we have to add state taxes. So actually, the tax the company would pay, we would have to add at least 5% to that tax. So again, in this case, it's around 39% is their marginal tax rate. So again, this is, I just wanted to kind of reflect, number one, that companies are paying how taxes are calculated. Now, this also asks one more thing. I just forgot about it right here. It says, this is what the corporation pays in tax. But if all of this was distributed to the shareholder, they would pay another 15% of that. So whatever 15% of that is, so we see it was what that, it's $1,800, roughly $2,700 odd dollars would also be paid by John because he received it all as a dividend. So the taxation, when we talk about double taxation, corporations currently pay lower tax rates in general, but the owners, because they pay taxes twice, that tax rate, that tax code has increased. So again, that's a basic overview of taxes and the financial statements of the company. I hope you liked the video. I'll talk to you soon.